afternoon. Your market news now. Financial markets trading in Asian hours were thinner than usual, with major centers including Hong Kong, Shanghai, Singapore and Seoul closed for the Lunar New Year celebrations. Many regional markets will remain closed until the midweek, and mainland China trading will only resume on the January the 30th, that is on Monday. However, nonetheless, oil markets have shaken off a weak start to the new year to move higher as China's outlook has brightened. Additional support for crude has come from expectations that the Federal Reserve is close to ending its series of aggressive rate hikes, which has weakened the dollar. To let us in on what we can expect for the coming week and perhaps even touch on some of the key themes that we should be looking out for, we are joined by Gary Boyson, who is a portfolio manager at Rand Swiss. Gary, thank you so much for your time. With the background that I've just described, relatively quiet start to the global markets with a week that has very little data releases. How are you assessing market sentiment right now?
Well, market sentiment is still pretty optimistic. We had, I suppose, a fluctuating, throughout the last week, but we finished very firmly on Friday in the US. S&P 500 is up almost 2%, up 1.89%. And that optimism is feeding into markets this morning. And as you said, we've got many of the Chinese markets closed for the Lunar New Year for most of the week. So it is going to be a thinly traded week. But that said, commodity prices seem to be holding up. We've got the resource index leading the gains on the upside. We're up over 1.5%. All share index up over 1%. So we'll take it. It seems pretty optimistic at the moment. But as you said, lots of concerns just simmering in the background. So the idea that Brent crude oil is starting to move higher now, that in part is as you said, because of the the idea that the Fed might not be quite as aggressive. It is weakening the dollar slightly, but it's also the idea that China is now through the zero COVID policy, and that we're going to have, I suppose, an opening China, and that could put upward pressure on demand. And we might just not have the same amount of supply to match it, and we might see higher oil prices, and that's of course going to be inflationary. So that is a potential negative. But overall, markets are optimistic, so we'll take it.
On that note, then, between interest rates, the dollar, or energy, which is likely to be the wild card here, or is it even central bank policy?
Well, it's a good question. So I don't know about the wild card. So definitely, I think energy is going to be, a wild card. I think energy, the energy security in the future is going to be absolutely critical. And I'm talking about higher oil prices, but domestically, I think, our own energy concerns around Eskom are a massive wild card. It's something that we've got to watch very, very closely. But I think, if you're trying to rank it maybe in terms of importance, I think the movement in interest rates is going to be absolutely critical. It's what pushes markets more than anything else. We can absorb energy price increases, but surprises in interest rates will really change things. Now, at the moment, the situation is rather odd. We have many central bank, at least Fed governors coming out, Fed officials at least coming out and saying that we're not going to see moves on interest rates, or certainly not moves lower on interest rates all the way out until 2025. We did see a slight softening of the rhetoric towards the end of last week, but the market doesn't believe this at all. We've got plenty of analysts coming out and saying that we might see interest rate cuts in the US as soon as the end of this year. Many people saying first quarter of next year, which is very, very divergent from what the Fed is actually saying. So you've got this disconnect between what the market is believing and what the Fed is saying. And for me, that is always very, very dangerous, and could prompt big financial market moves. So I think if I had to pick a wild card, I'd probably say interest rates at this stage.
You mentioned load shedding, and I'm curious, how concerned are you about the impact of load shedding on the mall operators as well as some of the retailers situated within those malls?
Oh, so you can see it already in the retail results, bemoaning load shedding, and I think anyone who lives in South Africa understands the impact this is having on not just malls but everyone. And the fact is that yes, malls often can have generators, and these retailers might be able to stay open through load shedding periods. The problem is that the consumers work for businesses that are shut and not making as much money as they could be, or have these increased costs because they've got to put in generators or solar or pay for diesel. And all of this, with NERSA obviously increasing the tariff potentially 18.65%. So things also looking worse. Now, this is obviously going to have a huge knock-on effect. We're going to have a lot of the retailers reporting this week. We've already had Mr. Price, who was pointing at load shedding as one of the reasons for a very poor set of comparable results. But no, certainly it's a problem. There's no question about it. Until we solve it, we're going to be in trouble.
You mentioned Mr. Price, the SA clothing retailers in this environment. What's your conviction on them?
I think Mr. Price is a fantastic operator, but you've got to look at them in the context of the domestic economy, and with load shedding and the persistent problems that we have around growth and unemployment, etc. Are consumers in a position to really help our businesses thrive? So if you're comparing, let's say, a Mr. Price or a fashion retailer in South Africa compared to potentially the US or Europe, I think I'd probably be at the same price. I'd be more optimistic about a developed market fashion retailer. That said, and if we look at Mr. Price's results, the actual headline numbers were pretty good, but this was because there's some consolidation in the sector in South Africa. So they were buying Studio 88. There's been a lot of acquisition. You've seen TFG also trying to fuel growth through acquisition. So there's almost this consolidation to try and improve the numbers, and it's not organic growth. So if you look at those comparable store sales in Mr. Price, a 3.9% decline, while prices were up 6.2%. So you've got increasing prices but declining revenues. So that's telling you exactly the story around volumes. They're just not able to sell the clothing at this stage. Now, there are some concerns. There was heavy promotional activity. So I think that has prompted some concerns that potentially Mr. Price has missed, I suppose, the fashion trend, if you want to put it that way. And they've had to aggressively discount just to move things off their shelves. But as I said, we'll know. We will have far more clarity by the end of this week after we see more retail updates coming out.
All right, Gary, let's leave it there. Thank you so much for your time. That is Gary Boyson, who's a portfolio manager at Rand Swiss. And we did mention very little on the data front, but we are expecting Q4 GDP numbers out of the US on Thursday. And then we continue with the earnings releases for the rest of the week. That is it from me. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.